this. All right, and thank you guys for joining today. What we're going to do is this quarter, I focused on the opportunity for growth, the opportunity for income type sales, income type opportunities. And so, what we're going to talk about today is one of our core five partners. We're going to look at Corbridge Financial with their product suite, and we're going to talk specifically about their accumulation product. Now, for those who don't know, I did work at Corbridge for about eight and a half years as a regional vice president. And they, in my opinion, are an unsung hero. They're kind of behind the scenes, if you will, compared to AIG brokerage side, like selected term and things like that. They have living benefits. And I think what you'll find today is as we talk about the QoL Max Accumulator, I'm going to show you where you can find the information. So if you're an agency builder, you can build your team here with all this free content. If you are looking to understand how to run the illustrations, I will show you that too, and how you can enhance that value for your consumer. At the end of the day, though, we are independent agents. I have 30 carriers at my fingertips. I have a core five that I like to work with. But if we need to, I tell everybody that if you look at a person is going to need different carriers for different reasons. Much like if you talk about underwriting, you have 30 carriers, all of which are artists, because underwriting is an art and not a science. And so our job is to find the right artist to paint the right picture of you that you want to put on your mantle above your fireplace. And so as we dive into the conversation today, what we're going to look at, as I mentioned, is the QoL portfolio. QoL portfolio, specifically what we're going to talk about is the Max Accum products. So once again, falling in line with the accumulation products and the opportunity for you to grow another line of income for tax-free retirement planning. So what you'll see here is a website that is easily achievable to get to. AIG has changed their name to Corbridge, so it's corbridgefinancial.com, and the product line is QoL. So if I did corbridgefinancial.com/QoL and I hit enter, it brings me to the same place. So this is their site that has all product information. It has agent recruiting information, agent development, prospecting, client conversations, and several resources. But what we're going to do today is I'm going to show you that if you click on products and you click on accumulation IULs, that will bring you to the QoL Max Accumulator 3. We're going to look at under product, see training, under product, the product overview today. Now, if you were at our event, you would have seen none other than Joe Ross talk about the 5-10-20 napkin tool strategy, which is extremely advantageous because it helps you understand how to deliver this type of presentation to consumers. So there are client sales tools here too, a Life with Confidence website that you can walk through a whole presentation with the client. And at the end is, which way do you want to go, Mr. and Mrs. Client? So we can always look at that as well as some resources to help you with your consumers. But let's talk product today. I'll show you how to run illustrations too. And we'll dive in here with the QoL Max Accumulator. So I'll pull this up. Once again, you can download that off the product section. And I'm going to apologize in advance for the massive amount of purple that you're going to see on the screen. So you know, I liked it when it was AIG because it was a light blue color. This purple is a very, very strong color. But what we're going to talk about is some of the benefits of the QoL Max Accumulator, i.e. maximizing your cash value, having volatility control options, and agile underwriting as to make this a very nice value proposition for you to add to your portfolio. So we'll start first with the agile underwriting or automated underwriting. So AU in the open market is considered automated underwriting. AIG coined the phrase agile underwriting to play off the words AU, and they added a plus at the end. But what that means is that from ages 0 to 59, up to $2 million, you can get non-medical or potentially non-medical. Okay. Now here's the cool thing that up to $1 million, you as the agent can actually do the Part B. Why is that important? Now we think about control. We think about the idea of wanting to have everything done as quick as possible, as opposed to waiting for the phone interview to call the client, or the client having to fill out the Part B. You can do that with them right then and there, up to $1 million. Now, over $1 million, you do have to do a telephone interview. Okay, why? Because it's a higher number. But that being said, I've seen some of these cases go through in 2 days, 3 days. Where you'll find this is going to fit, though, is when you have a client who is not taking medications, they're not diabetic, they're peak health, so to speak. Because when you think about it, the carrier is going to scrutinize more because they're taking a risk. They're not doing blood, urine, or anything like that. So they're basically offering an opportunity to get underwriting done quickly. And with that, they're going to do a background check. So when we talk background checks, we talk Milliman reports. More and more carriers are using Milliman, which will track your history through things like motor vehicle reports. They're going to track your ER visits, so your emergency room visits. They're going to track doctor's records. You're going to track medications that were prescribed. So if there's something behind the scenes that could be dictated as a concern from that standpoint, your client will automatically get a phone call to set up a medical exam. So just understand that this option is available, but it's not a lock that they're going to get non-medical. Now, this is an important feature right below this little bullet point here. So if, for example's sake, we've talked about this before with term, you can get $1 million potentially non-med with AIG or Corbridge. So I'm telling you here, you can get 2 million with the IUL. That does not mean you can get 1 million in term and 2 million, so a total of 3 million. Any amount of coverage that's inside or total in force is going to be debited from your opportunity to get non-med. So let's say, for example's sake, I have 1.5 million in term at AIG Corbridge already. And then I apply for a $2 million or $1 million IUL. Well, that in-force coverage will dictate the fact that I have to do lab work because I've already eaten up 1.5 million bucket of coverage at AIG Corbridge. So there are some rules behind that, the parameters behind that, to kind of keep the carrier in check, so they're not taking on extra risk or bad risks. And they do have a table shape, so this table A and B will get converted to standard on the permanent portfolio, not term. So if you did 500K term and 500K IUL, you could potentially get a table B term and a standard non-tobacco for IUL, because they shave the table and get you up to standard non-tobacco from the standpoint of how this all works. So it's treated the same. So you'll see that some carriers, when it comes to automated underwriting, they'll have an express underwriting. So like Mutual of Omaha, they usually have an express underwriting, which costs almost double what you would see for normal non-med products. So these are priced the same as fully underwritten, which is a benefit for the consumer. They've updated the illustrations so you can have a story or a value proposition where you could say, hey, we've got DB, we've got distributions, living benefits, and cash accumulation, and you'll have like examples on the side of that conversation. So it's a way to tell the story, not by raw numbers, but by showing the picture, showing the information on how the product is designed, and what the value proposition truly is right on the first page. Now we're going to get into some nitty gritty stuff, and this is important because what I want to say is I want you guys to be the best trained, bar none, when it comes to understanding and how these products work, so you can have an educated conversation with your clientele versus some people who will just run everything at 100% MLSB because it'll make the illustration look the best. So I'm going to break this down a little bit, line by line, not too much because I don't want to bore you to death, but understand some of the things that you have here so you realize exactly what the client should see as they invest in these type of portfolios. So you have two different lines. You have cap and you have par. Cap basically means you're capped at 10.5% right here. This can go up or down depending on how the performance of this product does. But right now, you have a cap of 10.5%. So, quick, simple stuff for some of the new people who are listening. Today is May 16th, 2024, and that is your start point. You invest, and May 16th, 2025 is your end point. So, that is point to point. We don't care what happens in the middle. All we care about is the start point and the end point. And then if the start point is less than the end point, you are going to get a form of credit in your account. And in this case, you would get a maximum credit if you had in the S&P a total of 10.5%. Now, it's illustrated about 6.48%. You'll see the MLSB, which we'll talk about in a minute and how that's structured, is at 100% participation rate. I've seen the MLSB go to 11%, 12, 13%, 14%. And so that means you'll get 100% of that. If that within your point to point hits, you're going to get 100% of that. The PIMCO is at 75%. It's a little more aggressive. I've seen that hit 17% before. But because it's so aggressive, there's levers that the carrier has to pull to keep more of a streamlined approach. That's why you only get 75% of that point-to-point growth. Now, what you see here in the far right-hand column is AVE. That stands for Account Value Enhancement. It is not a fee. So starting in year 6, you get the account value enhancement of 65 basis points, 75, 40, or 10. And so oftentimes people will illustrate, because if you see the cap rate is at a 6.48% illustration rate, you add starting in year 6, 10 basis points, you're at 6.58 from an illustration standpoint. But if you use 100% MLSB, you're now at over 7% when you're illustrating to a consumer. So that's why I like to say temper your expectations and run them at 6% where you can, so that way you're not giving people false expectations. So that's one thing that I'd highly recommend from a producer standpoint. Your client knows why you're doing that. So on the flip side is these 65 basis points, 75 basis points, 40 and 10, those are automatically added starting in year 6. You don't have to do anything. It just depends on what indice you're in. So if I had MLSB and it hit a 0, so remember, 0 is the hero, so 0% floor, you'll actually get credited 65 basis points for the account value enhancement, which is built into the product with no additional fees. So I like to diversify. I like to shift my mix a little bit between these so you have different indices for different reasons. So we'll kind of dive into the MLSB real quick. And if you see, it's designed between a couple different options. So first off, on the left-hand side, you have the strategic allocation. Okay, that's exactly what the allocation is. So you have a mixture between equities like the S&P 500 and fixed income type products. So your Merrill Lynch 10-year treasury. MLSB stands for Merrill Lynch Strategic Balance. If stuff hits the fan, like say COVID, they're going to look at it daily to make sure that they manage a volatile risk of 6% and stuff it all in cash if they need to. But really, what you're looking at the allocation wise is a combination of equities and 10-year treasuries. When we look at the Franklin Quality Dividend Index, this is a newer index to Corbridge. So just to give you an idea, I haven't had enough information on this to put a seal of approval, but it is the only carrier, only index strategy that has dividends that the carrier has. So if you're familiar with how mutual funds work, every year the mutual fund will offer a dividend as part of the return, or they give you a dividend as part of the return and things like that. Well, Franklin will actually take whatever that dividend is, not the actual dividend, but they will credit your index strategy as if you had that dividend added to your account. So it's the only index strategy that actually includes a dividend, much like if you saw here, the S&P without dividends. Okay. So here they're saying that the growth will add the dividend to give you that more consistent growth and more of a simple design. So the idea of higher dividends creates stable prices. You have a strong equity allocation as well, and they balance that between equity and cash on a daily adjustment. So once again, haven't had enough conversation around this to put the Phil Resch seal of approval. But if anyone has used this in the past and has seen an annual return, I'd love to hear from you. PIMCO is the other option. So PIMCO is one that has a big diversification strategy. So you have two sides of the coin. The first side, you have international and emerging markets. So right off the bat, that's a little bit more aggressive. As I mentioned, it's more of an aggressive index. Then you have small, mid, and large US cap. On the right-hand side, you have mortgage-backed securities, treasuries, and investment-grade corporates. They have a higher risk volatility of 7.5%. So you could see some bigger swings from PIMCO than you would from, say, a MLSB. And then I already mentioned the S&P, so we don't really have to talk about that. The S&P track record over the last, 90 years is about, I think, between 8 to 10%. So statistically speaking, it's within the realm of that cap rate. So it's a pretty solid setup. Now, what we talk about, so this is designed for income, the income strategy for the max accumulator product. You have loans available. So when you're taking out income, the idea of the design is loans, not taking out withdrawals. And when you take out the loans, you can do it in three ways. It's really two ways. Standard and preferred are together, and then you have participating by itself. So standard is if you take out a loan in the first 10 years, they're going to give you a credit of 2%, but charge you 3% for the loan. So remember, when you're taking income from a product, so say for example's sake, you have your cash value here, and then you take out a fixed amount, what they're going to do, whatever that number is, they're going to put it in a box over on the side. And if it's a standard loan, they're going to charge you 3% for taking a loan, but you can't have your money at a carrier without getting some form of interest. So they're going to credit you 2%. So it's almost like collateral that if you surrendered your contract, then all of the money that was in this fixed account will become realized, and then you'll owe the government ordinary income on that money. That's why we take loans, because we're borrowing the carrier's money. We're not borrowing our own money. Now, if we look at preferred, that's starting in year 11. It's 2% interest, a 2% credit, or sorry, 2% credit, 2% interest. So what that creates is a net zero cost loan, or a wash loan, as people like to say. Now, if you do the other option of participating, that means your money is still participating in the index strategy. It's still participating in the S&P 500. So if we talked about the participating and the loan is well, let's just say 5%. I know it says 4.5. I use simple math. Say the loan is this. but you kept your money in the index strategy, and the index strategy does a 10% return. Well, it's 10 minus 5%, and now you have a 5% credit on your borrowed money and 10% credit on the non-borrowed money. So you have the ability to get what they call positive cash arbitrage to continue to build up your portfolio while still taking loans out. A little more aggressive. You have to talk to your client about it. When people illustrate it, and I'll show you in just a minute here. I just want to check the time. When we illustrate it, most people do participating loans because it shows higher income. I don't mind showing participating loans because if it's a 4.5 or 5% return charge, and the index, the S&P does anywhere from 8 to 10% average, then you're going to win more than you lose, and that's why I don't mind the participating. So real quick, I'm going to cover a couple riders here and some benefits of having these riders, and then we'll show you the illustrations. So first one we're going to talk about is the select income rider. And the idea behind this is it gives you flexible income for your family or business. So if, for example's sake, let's go to this. You have a client who has, say, 2 kids. One kid is someone who likes to spend all the money. The minute they get it, burns a hole in their pocket. And then you have one who is very good with their money. You can use this select income rider where we'll create a payment schedule of 10, 20, or 30 years, and someone else might have a lump sum. So that's why I say you can do 10% up to 100% into this select income rider to allow the opportunity for the consumer to pick and choose how they want their beneficiaries to get the money. What it can do from an income standpoint is it can increase your opportunity for more income because you're going to reduce your insurance costs. It's only available at issue, okay? So you can't add it on later, but it can help lower costs. It's not a huge cost difference, but it can help. Say you get a substandard risk class or something like that as well, just another benefit. As I mentioned already, 10, 20, or 30 years, and it'll look something like this. So you have $1 million payout, and we're going to do it over 10 years. The client actually gets 1.046 or 1.047 million. So they're going to actually pay taxes on the 46,696 because that's gains on the account. But you're getting over $1 million over 10 years. I think you'll be able to pay the taxes on the 46,000. Just saying. Income for Life rider is a rider that's not often used, but basically it annuitizes your cash value so you get guaranteed income during your retirement. Now, what I will tell you, the difference between this and the difference between doing participating loans will be a lot higher. But if you need someone who's looking for guaranteed income, you have it. It's built into the product. Even if you sold Max Accum 1, 2, or now we're on the 3rd iteration, it has them all. So if you say, shoot, I got an older version, guess what? It's in there too. So you don't need to worry about that. Since your age is 0 to 75, you have a waiting period of 10 years. And you can't be younger than 55 or older than 85. So once again, it's like taking an annuitization or guaranteed income stream off of your cash value. I wouldn't recommend it, but once again, the needs of the consumer at the end of the day, if they need it, we've got it. Dollar cost averaging. So if you have a large 1035 coming in, I talk about it kind of like a roulette table. So if anyone's ever been to the casino, roulette, you have 36 numbers and you spin that ball around the wheel. And if it hits, you get a 36 times payout because you're on the number. Well, much like this, you have 365 days and your 1035 hits on one of those days. Do you want to gamble that large 1035 on one day, or do you want to segment it over 12 months so you get 12 equal distribution buckets? That's what a DCA is. It can take an annual premium, a lump sum premium, or a 1035 and put it over, say, up to a 12-month bucket stream. So it gives you more buckets. more diversification, and more chances to win. So you go back to the roulette table where you have a 1 in 36 chance of winning. Now, if you put on 12 numbers, 12 buckets, you now have a 1 in 3 chance of winning versus a 1 in 36 chance. Just for any of my gamblers out there. There's no charge for that. You can add it and utilize it. It's done at application time. Let's skip that. And then we have the AAS rider, which is a long-term care type rider. It's a pay for chronic illness rider. It's also commissionable for you as a producer. And what it does is it gives you dollar for dollar reduction. So instead of the living benefits where it's accelerated and say you had $1 million policy, AIG cuts you a check for 400 grand and the policy goes away. This is dollar for dollar acceleration. And how it's done is they give you a benefit. Let's just say this first, 2% or 4%, or the IRS per diem. If you're in California, there's no IRS per diem, but you still have 2% or 4%. So if I had $1 million policy, I would get $20,000 a month if I had the 2% option until that $1 million is fully liquidated or I pass away. You do not need receipts. You can spend it on whatever you want. So you can pay the neighborhood kid to mow your lawn. You could go to Vegas, put it on black and let it ride. The cool thing about this rider too is it's not required to be permanent, and you can even do a 50% benefit base. So if I had a benefit of $1 million, but I only wanted 500K for long-term care purposes, I could do that. And if I go on claim, all of my monthly deductions are waived. So no matter what, I will not have to pay any fees or costs of insurance while I'm on claim. And that's a big difference between that versus a long-term care rider like John Hancock, like Nationwide. Just an FYI. All right, so now what we're going to do is we're going to get into the illustration part. I'm going to share with you how to run an illustration here with the QoL Max Accumulator. Now, for some of you, we would have you log in through the 3Mark site, and you would go in through WinFlex there. Others who have a direct contract to them, you would go right on the Connects portal and do it right through there. But I have a direct link to WinFlex, so I'm going to use my own link. And I'm going to increase the size of this so you guys can see it okay. We'll go to illustrations, and I'm going to show you a couple different ways that you can run these, okay? So what we're going to do is we're going to wait for it to show up. I'm going to hit QoL and then the Max Accumulator 3. Create client. Okay, let's go with good old Phil Resch. And we're going to say, we're going to pretend I'm 40 and preferred, I wish, and a Tennessee resident. Some people will ask, on this page, what are these? The flat extras, table ratings, all that stuff. And if you have the date of birth, it's going to be better because your insurance age is 6 months before and 6 months after your date of birth for most carriers. So if I'm closer, say my birthday was in June, I'd actually be 41, not 40. Just an FYI. Flat extras, basically, if you have additional risks, so if you had cancer like 3 years back, they would insure you with cancer, or they would insure you now that you're in remission, but they might give you a temporary flat extra of $2 per thousand of purchase. That's what a flat extra is. It's an extra fee for risk. So we go to solve for, what they did here is they changed it to basically be an open forum. So it's a blank canvas right now. So it says no solve. It gives the producer the opportunity to more or less be the architect of their own design. So when you do accumulation sales, typically that's like, once again, if you're at the event, that 5, 10, 20, you put 5 in, it grows to 10, you pull out 20. The idea is I know the premium that the client wants, and I'm trying to solve for the death benefit or the least amount of death benefit. So when you go to solve for, we can change right here so there's not a lot of manual entry. Do solve for face amount because we don't care what the face amount is. We want it to be as low as possible. So right now that would not be the case. I want to change this option to minimum face, no mech. We do not want our policy to mech because then we lose all that tax-free opportunity and it becomes taxable. So minimum face, no mech. let's say, for example's sake, I want to put $15,000 away every year, and then I'm going to click on the calendar because I don't want to do that forever. Let's say I want to do that for 20 years. And then I'm going to double click here and put 0 and just click off of that, and I'm good. If you want to do it by age, you can do it by age as well. That's once again 20 years. And then I'm done funding the policy. The index strategy, as I've mentioned to some people, I like to diversify. So 33, 33, 34, or a combination that you feel is more advantageous for your consumer. But this is what I usually like to stick to. We'll get back to disbursements in a sec. This is the money page. When you talk about funding, I'm funding for 20 years. So I want the least amount of death benefit. So when you have increasing option, that's going to give you the smallest death benefit possible. If I did level, it would give me a higher death benefit. If you want to know why, we can talk about that offline. That's a longer conversation. But death benefit option, I'm going to click on the calendar here, and I'm going to change this to 20 years. Click off of it. It'll open up another screen. Double click this and change it to level. I'm going to pay a month or annually 15,000, but you can do monthly as well. If I were to offer a recommendation, annual is the cheapest cost of insurance, followed by monthly, followed by semi-annual, and then quarterly. Quarterly is the most expensive. Okay. So now we have increasing. We're going to increase as long as we fund for, and then we're going to levelize it after once we're done funding. And then we're going to go to disbursements. I'm going to check the box here, and I'm going to click on the calendar and age. So 40 is my age right now. And it's easier to figure out what time someone wants to take out income by doing age versus year. So I'm going to not take out income until, say, 66. And then at 67, I want to start my retirement, and I'm going to go to age 89. So when you see in the illustration, it'll go 68 to 90. It's kind of funky. But now we have 3 rows here. I'm going to double click on that, and I'm going to change it to solve for max. You'll see the loan options. Participating loan rate, 5.5%. AIG right now, or Corbridge, is giving you a 1% bonus on their loan rate. That's why on the other screen, it said 4.5%, because net total of the loan rate is 4.5%, just an FYI. So you'll see here, participating loan. If I wanted to change that to standard loan, I could. But like I mentioned before, I like participating better. And I'm going to hit calculate. My Starbucks. Hopefully, if Starbucks sees this, they'll offer me some money for plugging their delicious coffee. Probably not, but all right. So illustration is coming up here shortly. For some reason, AIG is taking their sweet time building them out, but we got it. Thank God. So 266, 428. That's the least amount of death benefit. If I put more in, then I'm paying more for cost of insurance. If I put less in, I risk the policy mecking and turning into an income product that I'm going to have to pay tax on. So this is the minimum without getting into the danger zone for 15 years, or 15,000 for 20 years. I'm going to click on the PDF here, and I'll show you a few pages. Okay, so this is the screen I was mentioning. You have the story right here if you want in one spot with the pie. So you have cash value, death benefit, living benefits, and it talks about all the things that you can get based upon what this product can give you. Going down to the narrative summary, as you can see here, 15,000 is the premium payment, 15,000 is the guideline level. Some people will say, well, what's the guideline single or the 7 pay? What does that mean? It means that these 3 are checkers in place to make sure you're not violating MEC guidelines. If you violate them, then you're going to have a MEC contract. So if you're looking for level premiums, because some people will try and do the 7 pay, and they can put more in the first few years, but then it gets all funky. The easiest way to do it is this one. So 15,000 a year guideline level. What I'm going to make on this is target premium 4,500. So as you can see, a lot of cash is going towards the crediting options. So now we go down here, we look at the rates, and you'll see 15,000. We're going to go all the way out for 20 years. So I've invested 300K. My death benefit is 798, and I have about $532,000 of cash value available. So if we look down now, starting at age 67 or 68, I'm pulling out $82,000 a year for roughly 23 years, I believe, ish. So 82,000. I still have $500,000 in death benefit left. I still have 275,000 in cash. So if I want to keep it going, I could. But this is a basic design. For those who raise their hand, just throw your questions in the Q&A. So this is still lecture format until July 1st. So what I would say is that this is a good design. This is a very simple design to help people get that retirement income that they're looking for. They don't have to take out the full 82. They can take out less. If they take out more, it would sacrifice some later income. But I'll give you a little tool that Corbridge created. If you slide all the way over to the right where it says more and click on supplemental retirement, it'll pull up a handy dandy retirement sheet. So it'll talk about some of the benefits of doing this. It'll talk about why the Max Accum 3. And then you have all the numbers in one spot, so you don't have to whip out a calculator. Mr. Client, you've invested 15,000 for 20 years, a total investment of 300,000. Your cash value by 67 was about 841,000. And then from that, we pulled out income of $82,000 a year for your retirement, or a total after 23 years of $1.88 million in tax-free income. That's with a conservative rate of return. If you look at the three of these together, it roughly averages out to about 6.5%. But this is your story in one spot. Now I'll give you one extra. So if I copy this, because this one is done, I like it. I understand that I can get 266,000 in death benefit. Now, let's say, for example's sake, we have a situation where the client is 40. Now, the peak earning years are mid to late 40s, early 50s. So if I wanted to build a buffer inside that the client could utilize as well, what I would do here is I would increase the face amount. So I know the floor is 266,000 and some change. Aziz, you got to put your question in Q&A. I can't take you off mute. So if we go here and solve for, and I change the face amount to no solve, okay, I know my floor is 266. What if I change this to say 400,000? I've changed nothing else. Disbursements, everything's the same. Increasing level, all that stuff. What we've done is we've increased the face. So the idea here, when you increase the face, that means I'm adding more cost of insurance. So if we look at that, if I'm adding more cost of insurance, what does that mean? Well, I'll show you. So if we look at the narrative summary, slowly but surely. All right, we look at the narrative summary. We'll see now that 15,000 for a $400,000 death benefit, but I can put in 22,453. So I've given a buffer or more of an opportunity for the client to put more money into the policy if they want to later, another $7,000. Also, from my perspective, I've made a little bit more money. So we've gone from $4,000 to 6,800. Let's see how it impacts the cash. So we were getting 82,000. Now we're getting 78,500. That's the cleanest number I've ever seen. So we've lost about $4,000 in income, or $3,500 in income. But what have we increased? We've increased the death benefit. So half the game is you actually getting to the retirement you want. If you get sick along the way, you have a higher living benefit opportunity by providing a higher death benefit to start. You're also giving the client the opportunity to put in more money later. So what you have is the opportunity to provide more income for the client if they want to stuff more in. Now, here's the cool thing. So here you have 15,000. As I mentioned, you have about 7,000 more that you can put in. Well, if I didn't put anything here, here, and say I got a huge bonus from my place of employment, say it was in the tune of $35,000. Well, I could throw that in because it would still be within the guideline level premiums in year 6, and it wouldn't impact the policy. It would not be a met. So you have the ability to put more in later where you might not have in the other scenario. And so that gives your client more room to stuff money in later without having to go through underwriting again. And so client gets higher living benefits. They get more room to put more money into it later. And it didn't impact the cash that much. If we're talking $4,000 a year in change between hypothetical rates of return, you're looking at what is 4,000 divided by 12, $333 a month. In the grand scheme of things, if I have the ability to put more money into it later, then the opportunity from that standpoint, I would say, is worth it. But you can show the client both options so they have an idea of max funding and they have an idea of adding a little bit more death benefit to help them in regards to funding more money into it. So one of the questions is going back to the information here, 15,000, they're asking, can you add only another 7K? Well, you want to make sure you stay within the limits, the guideline level premium, so you can add $7,453.93 more. But as I mentioned too, is if I don't do it in year 1, that goes into another bucket or a pool of money that I can add to in year 2. So if I miss next year, I could add another, let's just say for easy math, $15,000 on top of the other $15,000 I'd be paying. So yes, there's more opportunity. Another question, would it be better to do 2 policies if they want to fund more later? That way at least one contract is max funded. So if they change their mind, they don't add extra funds, only one policy is underfunded. It's a good question. You know, there's 2 ways you could look at it. So if I went with option number 1, right? And option number 1 was that 266,000. What you can do with the AIG product that you can't do with any other carrier is you can add a term policy. It's its own separate policy, but get discounts by bundling the 2 together. So instead of doing 400K, what I could do is I could do 250 or 266 in permanent and say a $250,000 death benefit in term. And that would get me a total of 500K, but I'd be spending more than 15,000. I'd be spending 15,000 plus whatever the cost of the term is. The other thing is some people don't find value in buying term, and I'm also buying it at a 40-year age, so my cost of insurance are less. So if I bought a 40-year and then I bought a term and then I converted 5 years down the road, I'm now 45 and my costs have gone up. So there's pros and cons to both. Really, when I show these, the whole idea is having the educational conversation with your client. And really, when you ask them a lot of the questions, they're the ones who will give the answers. And so it's really more them coming up with a decision of what they want to do. You're just the conduit to provide them options. But if you provide more than 2 options, then they're going to think about it and may not get back to you. So just kind of err on the side of caution with how many options you show a client as well. If you wanted to add that term rider, and not term rider, but term policy, you could do it through here with the discounts tab. And if I did 250,000 and I did it for say 20 years, I could do that. The riders, like the AAS rider, is right here. I can illustrate that. The other ones, like the select income rider, so you could shave costs by doing this 10, 20, or 30 years. I usually don't do it, but if we showed, say, the term rider, I keep saying term rider, the additional policy, what you'll see is there will be a spot in between the permanent policy and the term policy. There will be one sheet that will show what type of discounts you get for buying two policies at the same time. This is called QoL Advantage, and QoL Advantage gives you the ability to bundle when you buy multiple policies yourself. I don't get a discount if I buy a policy and my wife buys a policy, but if I buy a permanent policy and subsequent terms, up to 4 terms, I'm going to get a discount, which is seen right here. 18,000 for the permanent. It would cost me for a 20-year term for 250K at 40 years old, 268.50, but I'm getting a $78 discount, so it's 189.93, or I'm saving $78.67 per year. So that's just some of the cool perks that you can have with this. A lot of different ways you can modify the illustrations, a lot of different opportunities. But at the end of the day, it's all about having the right conversation with the consumer, asking the right questions to get to building out this type of portfolio or product. So, so really, that's kind of it in regards to the presentation. Want to give you just an insight on the product itself. Want to give you insight on how to run a LIRP, life insurance retirement plan illustration. There are many different ways you can modify it. You are the architect of your own design. And that's why I say it's definitely worth playing around with the software, even for yourself, if you're thinking about doing it for yourself. So what I'll say now is, if anyone has additional questions, feel free to put them in the chat.